Stop what you're doing right now. If you hold any industrial stocks in your portfolio, you absolutely need to see this 5-model valuation breakdown of DXP Enterprises. Seriously, last week I ran this massive fragmented M&A machine through 5 strict financial models, plus Warren Buffett's and Peter Lynch's ultimate stock checklists, and what I found completely shocked me. Think about it. Retail investors constantly stress over whether they're buying into a solid compounder or just catching a falling knife masked by heavy debt. Well, what if I told you this company is generating a massive 34% return on invested capital, but they're doing it by gobbling up regional distributors like a game of Pac-Man? Is DXP a Buffett-style value buy or a Lynch-style growth trap? By the end of this explainer, you'll know exactly where it stands, and I'll give you a clear, actionable framework you can steal to evaluate it yourself. Let's dive straight in.
Now, we're going to start with a pretty shocking statement right from the top. Listen to this remarkably candid anchor from CEO David Little during their latest earnings call. He outright admitted that the year started completely stalled, saying January was surprisingly slow. I do not have a clue as to why. How often do you hear a CEO openly admit, I literally do not have a clue? Never, right? Retail investors usually run for the hills when they hear that kind of uncertainty. It's a huge pain point. But honestly, this raw honesty perfectly sets the stage for a quarter defined by early friction, followed by a rapid, powerful rebound. Let's see what the numbers actually say.
Okay, here's our game plan for today's explainer. First, a quick Q1 2026 financial snapshot. Next, we'll look under the hood of their acquisition growth engine and then dive deep into margins, debt, and valuation. After that, we'll map out DXP's strategic moat, highlight the tech debt and risks, and wrap up with their future outlook and AI potential.
Section 1. Q1 2026 Financial Snapshot.
So about that slow January, check out the momentum building right here. Average daily sales rapidly accelerated from $7.2 million in January up to $8.4 million in February, and then surged to $9.2 million a day by March. That is a massive 28% growth in daily sales velocity from the start of the quarter to the end. It completely proves that whatever caused that January stall was strictly a temporary hiccup.
And that brings us to the big headline result, a super solid 9.5% year-over-year revenue growth, pushing total sales up to $521.7 million for the quarter. Look, in an industrial market where so many competitors are fighting just to tread water right now with all the macroeconomic uncertainty, posting nearly double-digit top-line growth is a massive achievement. It definitely demands a much closer look at how they're pulling it off.
Which brings us to Section 2, the acquisition growth engine.
Leveraging a very decentralized network model, DXP generated $40.7 million in sales this quarter, entirely from companies they acquired less than a year ago. Just think about that for a second. They aren't just sitting back relying on organic growth from their legacy service centers. No, they are aggressively buying up market share. They fold in these regional distributors, leave them on a decentralized network, and just let them capture local demand. It's a brilliant roll-up strategy.
Just to give you a sense of the sheer speed here, in the first 3 months of 2026 alone, DXP closed 3 major deals: Mid-Atlantic Storage Systems, Premier Flow, and Ambiente H2O. These acquisitions immediately pumped up their presence in critical water and wastewater markets, and they are absolutely not hitting the brakes. Management confirmed they already have 3 more targets locked under active letters of intent for the second quarter. They are an absolute acquisition machine.
All right, Section 3, margins, debt, and valuation. Let's see how all this buying impacts the balance sheet.
For all you finance nerds out there applying those valuation models we talked about, taking a look at these exact multiples reveals a pretty leveraged position. Notice that 1.71 debt-to-equity ratio and a net debt-to-EBITDA multiple sitting over 3. Now, this elevated leverage didn't come out of nowhere. It's the direct result of recently raising over $200 million in debt just to fund these aggressive acquisitions. They are clearly willing to carry a much heavier debt load than some of their more conservative peers to execute this grand consolidation playbook.
But here's the counterbalance to that leverage. This is the crucial metric, and honestly, the exact kind of number that would make Warren Buffett sit up and take notice. A highly impressive 34.1% return on invested capital. This number is absolutely massive. It tells us that despite taking on high debt, the capital they are deploying into these new businesses is generating incredible outsized returns. And that's largely being driven by expanding gross margins, which hit 32.3% this quarter, coupled with some really strong operating leverage as they scale up.
Let's move to Section 4, DXP's strategic moat. What exactly protects these returns?
When you look under the hood, there is a very deliberate, highly profitable shift happening toward engineered solutions, While traditional service centers still make up a hefty 65% of the pie, the innovative pumping solutions segment, which is all about highly custom engineered pump packages, grew a staggering 37.7% year-over-year. They are intentionally maneuvering away from low-margin commodity parts and pivoting hard toward complex, high-value systems. And this is their moat. It's this hard-to-replicate engineering knowledge around complex industrial pumps that keeps major oil, gas, and municipal water clients deeply embedded with DXP. Think about it. If a critical pump suddenly goes down at an oil refinery or a huge wastewater plant, it literally costs them millions in unplanned downtime. Those customers aren't just going to log on to a digital marketplace to buy a cheap replacement. They rely heavily on DXP specialized engineers to design, fabricate, and repair these critical lifeblood systems.
But it's not all sunshine. Section 5, Tech Debt and Risks.
Here is the ultimate trade-off of their rapid expansion strategy. On one hand, their external M&A execution and technical expertise are top tier, no doubt. But on the flip side, buying dozens of different companies has directly led to some serious internal tech debt. They're operating on a whole bunch of disparate ERP systems. This creates massive data silos and operational inefficiencies that act like an anchor, dragging down their bottom line.
Because of these internal headwinds, operating costs noticeably ticked up this quarter. Selling, general, and administrative expenses rose to 24.2% of total sales. A big chunk of that was due to the expensive friction of integrating all these new businesses. We're talking legal, consulting, and audit fees. Plus, they're navigating supply chain delays that are stretching out timelines on their long-cycle water projects. So the true hidden cost of this decentralized, fast-paced growth is a much heavier, far more complex administrative burden.
Which brings us to our final part, Section 6, Future Outlook and AI.
To tackle that tech debt head-on, management's stated key objectives right now involve a massive internal modernization effort. Number one, they absolutely must consolidate those legacy ERP platforms. While doing that, they're also pushing to diversify their revenue away from cyclical oil and gas markets by leaning a lot harder into food, beverage, and water sectors. And finally, they really need to build a robust digital experience and customer portal just to fend off those purely digital-first competitors.
Now here is the really exciting part. If they can successfully unify that fragmented data, DXP sits on an absolute gold mine. By cleaning up those data silos, they unlock a super lucrative opportunity to deploy artificial intelligence. With literally decades of transactional and operational data on exactly how and when complex machinery fails, DXP could completely shift their model. Instead of just selling replacement parts when things break, they could sell guaranteed industrial uptime, powered by predictive AI models. That's a huge potential unlock. Which leaves us with this final, absolutely critical thought to chew on. DXP has clearly proven it can acquire and grow at an incredible scale, generating massive returns in the process. But will their internal software and data strategy actually modernize fast enough to support their massive real-world footprint? Can they pull off the transition from a traditional industrial parts network into a highly integrated digitally powered solutions provider before the digital-first competitors catch up? It is going to be a fascinating transition to watch play out. Thanks for joining me for this explainer, and I'll catch you all next time.